Welcome to a session in which we will discuss customer credit policies. In the 4C plus E business viability framework, as part of the first step, we discussed points about likely customers of a business and what their needs are. We also discussed that it is crucial for a business to ensure that its products and services fulfill customers' needs better than or as good as its competitors do. When we looked at quality, we discussed that if a business is able to deliver good quality at a responsible price, then its products and services become attractive to the customers. There is another aspect which helps customers decide if they should buy products and services from a business. That aspect is the credit extended by the business towards them. We will look at it closely here. Let's first remind ourselves about typical customer segments for businesses. A business may sell to individuals called retail customers who usually buy in small quantities. These retail customers are often frequent or repeat customers. There are other customer segments such as institutions, businesses, and wholesalers who usually buy in large quantities. The retail customers often struggle to pay immediately, and hence they tend to buy more if a business gives them credit. The large quantity buyers expect credit in addition to discounts, which means their payments to a business are not only delayed, but they are often large amounts. While we can say that for any business, the best approach is to avoid giving credit to customers, as it is not practical to do so. Receiving credit is an incentive for customers to buy a business when retail customers and large buyers do not receive any credit for a business. These customers may choose to buy from competitors and not from the business. So, a practical approach for a business is to define credit policies for customers and then track credit given so that the payments are timely. Why do you think setting such credit policies are important for a business? Without clear credit policies, a business is likely to suffer in three ways. First, it may end up losing money to customers who do not pay back at all. Second, it may end up giving credit to customers who take too long to pay back. Finally, the business may give away too much credit to the customers, which will adversely impact the working capital of the business. Hence, adopting good customer credit policies helps businesses stay financially healthy. Customer credit policies require a business to make well-thought decisions about 5 parameters. Let's look at them briefly first, and then we will discuss each of them at length. The first aspect of credit policies is for business owners to decide on the maximum amount of revenues that they want to come from credit revenues. The next point of credit policies is for a business to decide which type of customers will be given credit and which ones will not be given any credit. The third point is about deciding credit amount limits for each type of customer to whom credit is extended. The next important point is the duration of the credit that will be allowed for each customer type. Finally, the credit policies are not complete unless the business owners also think for the penalties or consequences in the case of delayed payments or non-payments. Let's look at closely to each of the 5 parameters. We will begin with the first point about how much revenue should come from credit and how much should come from cash. This question has no straightforward answer. Often, at the start of a business, the owners may decide to be aggressive and give credit liberally. In such cases, the owners may often choose to have 40 to 50% of the total revenue to come from sales on credit. Sometimes, it also depends on the nature of the business. In those businesses where the cost of making a product is very high or a cost of delivery of the service is very high, then a business may choose to accept very small revenues from credit. In fact, the business may ask for advances from its customers in such cases. For example, if a school places a large order of snacks for an event, then the shop owner might insist on 50% amount in advance and the remaining payment upon delivery of the snacks, thereby offering no credit. So, while it is difficult to generalize, a good rule of thumb is that the credit revenues should not be more than 25 to 30% of the overall revenue. The second parameter is about deciding which customer types should be given credit. It is a good idea for business to offer credit only to those who are long-term or repeat customers. A new customer should not be given credit unless he or she has become a regular customer. A business should consider giving credit to those who buy in bulk because they are likely to provide high revenues for a long period of time. But sometimes it is a good idea to offer such bulk customers a discount instead of credit. The next parameter of customer credit policies is how much amount of credit should be given. Businesses work in a competitive environment. Hence, a business owner must consider what is a normal practice in her type of business when it comes to providing credit to customers. It is a good idea to use the same rule of thumb that competitors use. A business may offer a bit more credit than competitors if it helps get additional market share. Another important consideration here is how much credit can the business afford to give. This will depend on the working capital available for the business. If there is not enough working capital available, then the credit amounts should really be very small. The fourth parameter is about the length of the term while giving credit to customers. Once again, it is important that the owner follows what is considered to be a normal practice in her type of business. For example, if most grocery shops in the area are offering credit for 7 days, then a new grocery shop in the village should follow the same length. The other important consideration is for how long can the business afford to wait for the payment. If there is not enough working capital to pay day-to-day costs comfortably, then the credit period should be as short as possible. The final parameter of customer credit policies is the toughest to decide as well as to implement. It is about penalties or consequences in case of delayed payments or non-payments. The most practical approach is to negotiate some immediate payment with the customer, even if it is a partial payment. It is a good idea to contact regularly based on the agreed upon follow-up dates. In case of delays, the business owners must not hesitate to take a step immediately, stopping delivery of products or services to the customer until all the due payments are cleared. As a last resort, consider including penalties in credit policies. But this is difficult to implement and may also lead to spoiling of the relationship. So, instead, it is better to focus on the first 4 parameters of the credit policies because they are preventive measures and they are easier to implement. It is important to note that credit policies are not static in nature. As a business undergoes changes and as its owner becomes more experienced, she must change the customer credit policies to help the business grow. It is also not necessary to have only one set of customer credit policies for a business. For seasonal businesses, it is a very good idea to have one set of customer credit policies during the period of high demand of products and services and another set during periods of low demand. Just creating and when needed, changing credit policies is not enough for a business. Every owner must keep a record of customer-related credit transactions in Credit Given Register, which we have discussed in a session covering records kept in a business. The Credit Given Register is a systematic log of who owes how much to the business. Typically, every day, there are 5 things recorded in it for every credit transaction. The first is the name of the person to whom credit is given, followed by the credit amount. The third item is the date on which the person is expected to pay the due amount. The register then also tracks if the money has been paid back yet or not. And if it is paid, then finally, what was the actual day on which the due amount was paid? To summarize, giving credit to customers is important, as doing so helps increase revenues of the business and also helps business gain customers. But business owners must be very careful about giving credit to their customers. Every business must have credit policies in place for its customers. The credit policies should cover 5 things. First, maximum amount of revenues that the business would like to get through credit. Second, which types of customers will be given credit. Third, credit amount limits for each type of the customer. Fourth, duration of credit that will be allowed for each customer. And finally, penalties or consequences in case of delayed payments or non-payments. Credit policies must be dynamic and they should change based on the business experience and the changing conditions of the business. Every owner must keep a record of customer-related credit transactions in Credit Given Register and periodically review the records. That, in a nutshell, is about customer credit policies.